What's going on? Welcome back. Ryan here. In this video, we're talking about implied volatility. Now, I know in the last video I talked quite a bit, but I really wanted to make the distinction between volatility and implied volatility. So I have Thinkorswim loaded. We have a chart of Apple here. And what I want to do is I want to come inside the studies here, and we're going to type in volatility, and we're going to bring up historical volatility and implied volatility, right? So it's important to understand that there's a difference between the annualized movement of a stock's price, right? What its historical volatility has been of that underlying asset, right, versus the implied volatility that's derived from an options price. That's a forward-looking metric into what the market is pricing into a certain move. Okay, so for instance, we could see that the historical volatility annual, right, 20 periods is increasing for this time period, right? And that the implied volatility, when this made these sharp moves downward, that this implied volatility shot up, right? So right now, the implied volatility is slightly more than the historical volatility. And let's look at something else. Let's look at Microsoft. Right, so again, the historical volatility is less than the implied volatility, and this makes sense, right? Because the implied volatility, like the implied volatility, always tends to be more overstated than what the historical volatility actually is. This is a really important concept to understand, right? That the markets are not going to move as much as you think they are, right? Which is why, you know, in the beginning when we were talking about indicators and the correct way to look at the market, that I said just how important it is to use something like, right, these three Keltner channels, where we could come in here and go, change that to 1, 2, 3, right? And we could look at these Keltner channels, and we can actually see, what, one standard deviation looks like, what 2 standard deviation looks like, what 3 standard deviation looks like, right? Because when these markets start to make these improbable moves, those become high probability scenarios where we can put on trades that will be profitable. So historical volatility, implied volatility, regular volatility are super important metrics to be aware of when we're trading options, right? Because logically you want to think to yourself and come to the conclusion, well, yes, if volatility is high, maybe it's higher than the historical, and the option prices are reflecting that, then it would be better to use a strategy where we're selling that high volatility, right? We're taking advantage of the option prices being higher than normal, and we're selling those overpriced options, taking advantage of the theta decay and using that to our advantage, right? The other way that you could look at this is if volatility was historically low and option prices were extremely cheap, well, then it's better to buy those cheaper options and use strategies where we take advantage of that low volatility. So again, I hope this is helping you. These are really important concepts, and we're going to continue to look at them. We're going to continue to talk about them as we trade, as we move forward. And, regardless of where you go with your trading career or however far you want to take this, these will always be important metrics to understand and think about and be aware of. Okay, so again, reach out, let me know if you have any questions, and I look forward to talking with you in the next video.